While markets debate the health of the U.S. economy, my next guest says corporate indicators are pointing to stronger growth ahead. And he believes they're a better gauge than traditional economic data. Joining me is Robert Cohen. He's Director of Global Developed Credit at DoubleLine. It's great to have you in the house, by the way. Welcome.
Yep.
So I'm actually really glad you're here because it's important to point out, while we can argue about what exactly is going on with CPI and what exactly is going on with valuations in the stock market, it's a pretty clear signal coming from the corporate credit space right now, where at least as I've seen, investment grade spreads are the tightest they've basically ever been. Can you elaborate on what you're seeing right now?
Yeah, so for the last couple of years, many of the macro indicators you mentioned, the yield curve, ISM, CPI, all these indicators have recently indicated maybe there's economic weakness. I think it's just been disrupted by inflation, rising rates, fiscal stimulus. I think you have right now the Fed pressing on the brake while you have fiscal stimulus pressing on the gas. I think it's caused a lot of the indicators to maybe kind of
go haywire.
False negatives and go haywire. Corporate credit is maybe closer to the ground, where you're talking to individual companies, seeing what their earnings are doing, and that builds up to credit spreads. So credit spreads have been falling all year.
Yeah.
High yield in particular, people refer to it as the canary in the coal mine. These are companies that are most sensitive to economic conditions.
They're the weakest, they're the most, kind of the highest debt levels, the most potentially likely to default. Their rates are high, supposedly higher for that reason. But where are we these days on
record lows? But there's a reason for it. There's some logic to it. You have a very low default environment. You have really credit quality has been improving since the Fed started raising rates. I think something that's underappreciated is that once the Fed started raising rates, M&A basically froze.
Deal making, yeah.
Where we are in the credit cycle right now, normally when the Fed is cutting interest rates, that is usually coincident with a big boom in M&A. That's when the risks build in the economy. That starts to spill over into the broader economy. You have weakness, and then the Fed is forced to cut because of economic weakness. We haven't had any of that, and so that's part of the reason why the credit market is in good shape, because we haven't had this excessive risk taking. If anything, credit quality has been increasing. If you look at high yield, we have mostly double Bs, is over 50% double B. Duration is much lower; it's 3 instead of 4.
Wow.
There's a large portion of secured credit in the market, and part of the story is the tail risk. The riskiest parts of the high yield market have been going to the bank loan market and to private credit.
So, which is a great point for those who are, again, thinking about getting into the private credit space, as that becomes more open to retail investors. Some of what used to be here is now kind of being pushed in that direction. I guess my question would be, watching all this, and we were talking a little bit about this yesterday, is this a sign to you that there's too much liquidity in the economy right now? Obviously, I appreciate that the fundamentals are good, but are the fundamentals better than they've been since 1997 to justify spreads this tight? Or do you think there's just literally too much capital that is pushing rates lower, and a sign even that the Fed might be running a policy that's too loose, not too tight?
I think it's a combination of both. Clearly, there is very high credit quality, but there also, because there was no M&A that I was speaking about, issuance has been mostly refi. There hasn't been the supply of new bonds. I think the hope for 2025 is as M&A improves, you start to get more issuance and you get a more, equal supply-demand balance. But clearly, part of the story is a lack of supply that's pushing spreads tighter. You can't ignore that.
One final question. Normally you'd say, listen, you can get, high yield at whatever, 6 or 7%. And I mean, just think about, what a great opportunity that is. But people are looking at a stock market that has gone gangbusters. So is it harder to coax people when they think, well, it's kind of similar risk profile, and in equities, I have this incredible upside, and not, maybe with credit's a little bit more capped?
Well, valuations are stretched everywhere. A little bit of comparison versus 2017, because we talk a lot about new Trump 2.0 versus Trump 1.0. In 2017, equities S&P had a multiple of 20, so that was an earnings yield of about 5%. High yield yielded 5% then, and then treasuries were in the 2s, so maybe IG got 3. So equities were much more attractive on a valuation basis back in Trump 1.0. Fast forward to today. Equity markets are roaring. You have a multiple of 25, which is really, so that's more of a 4% earnings yield. You see where the 10-year yields now in the mid-4s.
Yeah, treasuries are above that level, let alone.
And you can get in high yield 7. So while spreads are tight, all-in yields are actually quite high. And they're quite competitive, actually, with equities. There's street estimates now, which maybe they get updated and revised, but a lot of street updates that even come out after the election are calling for 6 to 9% total return on the S&P for the next 12 months. Well, if you can get 7% in credit, that's actually a pretty favorable comparison. Yeah. And don't forget, while spreads are tight, all-in yields are high, and that protects you against some of the downside.
No, I think that's true. It's incredible to see. It almost feels like everywhere you look, that you can do well here, and you can do well, and you can do well everywhere. And we'll see how long that continues. But Robert, thanks for joining us. Really appreciate it.
Okay, thanks for being here.
Robert Cohen with DoubleLine.